What are your thoughts on the Fed then, Peter? How many do we get from here? Bloomberg Intelligence telling me this morning that the 3-rate hike Fed, this is 3 hikes in 2017. We've had one already. It's a kind of 50-50 for markets.
Yeah, we're on the less rate hikes, a shallower curve. You know, as you said, the PCE numbers are not coming in. We saw a dip from that sort of upwards rising trend, and I think it's going to make it difficult for the Fed to really step on the brakes. You know, but as you said earlier, you know, the labor market in the U.S. is really strengthening, and it's strengthening well. You have unemployment down at 4.5. You have earnings growth now picking up, participation ratio improving as well. I think the Fed is going to look at that and say, okay, that's really important. Things are tight right now. We need to sort of clamp it down. So I think we see one in June, one in September, and we're done for 2017.
But there's a battle that they've got to wage. There's a lovely preview. Don't be fooled. The Fed is more of a duck than a decoy. The Fed meeting is more duck than decoy. Basically, you've got a calm demeanor at this meeting, but there's a vigorous paddling going on underneath because what they really want is to zero in on a comprehensive strategy to reduce the size of the balance sheet. So for me, tonight's note from the Fed is going to be about that balance between hike versus balance sheet. If there's any nuance there, I think that's what shifts the market.
I think that's a big piece of it. I think, you know, if they shift away from interest rates and more to balance sheet management, I think that's a big thing for the markets as well, especially FX traders who are expecting, you know, higher interest rates and the effect on U.S. dollar is one of the primary reasons for positioning, you know, in Q2. So if they shift to that balance sheet management, it means that sort of the strong dollar positioning is going to be less likely. So that's going to be big piece for FX traders. The other thing I think they need to do is balance the softness that we've seen in Q1 and start saying, okay, this is just transitory. We still have confidence in the U.S. economy, and I think signaling that they have, you know, faith in what's happening in the U.S. from a fundamental standpoint is also going to be extremely important.
And we're going to be watching the non-farm payrolls number, the jobs report, of course, on Friday. How strongly positioned in the dollar is the market at the moment? What do you see, Peter? Therefore, how will they respond to these numbers?
I think the positioning in dollar has come off significantly. I think, you know, there was a build-up for 3 or 4 hikes, you know, earlier in the year. It's come down to now 2, maybe even 3 on the upside. People have pulled off the dollar positioning, so on the IMM level, it's significantly lower. So there is positioning or a possibility that there is a positioning in U.S. dollar if the Fed comes out and says, you know, we still have faith in the U.S. economy. We still are going to use interest rates as a primary tool for managing the monetary policy, and so watch that dollar pop. So we're expecting for the next, you know, few months the dollars to start gaining the upper hand, especially within the G10.
Get ready for the dollar pop. Where do you think that's most? In dollar yen or
dollar yen's going to be the big one. Obviously, the sensitivity, especially on the short end of the curve, dollar yen is really prone for an upside move. So dollar against yen is one of our key movers for the G10.
Okay. Obviously, the Fed have taken a poll. They've gone out into the market. Sorry, not the Fed. The Treasury's gone out into the market and they've talked about what would you accept: 30-year paper, 40-year paper, 50-year paper. And it looks as if they mirror what happened with the rest of the central banks around the world, they'll go for the 40 to 50-year paper. That pricing, is that going to be important? Because that's going to affect, this is the 10-year government bond yield, which inextricably linked to the dollar. How big a piece of news do you think that might be about ultra long?
Listen, I think from our position, we don't think it's going to be particularly revolutionary. First of all, the 10-year Treasury is probably one of the most liquid, most traded, most understood instruments out there. And I don't think that's going to shift overnight just because they add a little bit of duration to the curve. So, you know, to me, it's not going to really affect our forecasting in the short run.